So the buyer gets a high ratio mortgage. He needs to or she needs to get the mortgage insurance. Is it the same as this is the same or different?
Yeah. So when somebody has a high ratio mortgage, which means the down payment is less than 20%, which means loan to value is higher than 80%. In a high ratio mortgage, they are required to purchase default insurance. The default insurance means that the insurance comes into play when the borrower defaults, right? So that means they're not paying their mortgage. What happens is the lender will then sell the property in order to recover the money. But if there is a gap in what they're able to sell the property for versus the loan amount, so for example, let's say the mortgage amount is 200,000, but they were only able to sell the property for 180,000. Now there's a $20,000 loss that the lender will be taking. So the default insurance will pay for that loss to the lender. So it protects the lender. This has nothing to do with the title. This is when borrower defaults on the mortgage. That means they're not able to make the mortgage payments. And then a sale happens, the lender sells the property. And if they don't get the same amount of money as a mortgage, and of course, there's some fees and penalties that are applied on top of that. So if the sale proceeds don't cover all of that cost, that's when the default insurance comes into play. Title insurance, on the other hand, just protects the title. So if somebody, let's say, does fraud, right, and they sign somebody's name and sell the property, this happened in Ontario. So in that case, title insurance will basically pay the lender for the mortgage. So in this case, the buyer is not defaulting on the mortgage. It's just that somebody stole their property, right? So that's when title insurance comes into play. Default insurance is more when they're not able to make mortgage payments.